Very good morning, Tuesday the 18th of July. So good to be back. Wasn't here yesterday, but as I understand it was a fairly quiet day, kind of reflective of, as I'm sure Piers would have covered, the beginning of the kind of UK school holidays. So typically that does tend to result in some a kind of lower level of tradable volume in the market, I guess, and also usually on a calendar perspective it tends to be fairly quiet on a Monday, and with earnings season now underway, as far as earnings are concerned, it tends to really peak in the number of companies that report midweek, so predominantly Wednesday and Thursday rather than the Monday and Friday. But we'll get on to some earnings that we're looking out for later. But firstly, there's been some big news overnight, and as you can see by the charts, both major pairs, so Eurodollar and cable, have seen a pretty decent pop on the upside. I'm looking at 30-minute candlesticks here, so you can see around kind of 2 a.m. both Eurodollar and cable launching higher. Gold moving on the upside, however, has come back slightly as Europe has come in. Equities weakened, and so what's happened here is, this is the main headline: Trump suffers stinging defeat as Obamacare overhaul collapses. So news out of Washington that 2 more Republican senators have opposed the latest version of the healthcare plan. So when I think about how many months it's been since they first tried to repeal Obamacare, it was kind of one of the first things that Trump pursued, because it was the staple, if you like, of Obama's presidency. That was the first thing then he wanted and aimed to overturn, and yet here we are. If when you think about it, the election took place in November of last year, and we're in July now of 2017, and still they've not managed to get it fully through both chambers of Congress. So what does this spell? Well, it brings about the usual fears about what is it that Trump can actually manage to deliver in the long term, given the fact that he seemingly is falling at the first hurdle here with the healthcare issue. So more kind of market sensitive ones like corporate tax. When was the last time you heard about Trump talking in detail about the corporate tax cuts? I haven't even heard of that since we saw that one-page doc about 3 months ago. All of this just means it gets delayed, and this whole kind of built up asset prices that we've seen, particularly in the equity market, becomes more at risk of a potential correction, in that he will be unable to deliver, certainly in the timeframes that many might have initially believed. So equities were weakened overnight. That impacted really the Asia Pacific session. So we've opened with a negative kind of risk-off feel to the to the session this morning. Just looking at the DAX here as I speak, the Euro Stoxx is at session lows. So looking at the DAX, we gapped lower. Initial rundown in the futures to the low print that we had in that fairly consolidative kind of range from yesterday's session. We've broken down through S1 this morning, and just looking a little bit longer time frame here for the DAX, you can see we've just pushed down to this 12,483 level, which is quite an interesting level, because you can see it was the support back on the, would have been the 18th of May, so going back quite some time. There's also a period of resistance as well back in the beginning of this month, and here we are now just testing down at that level. You can see yesterday as well we had a little test down at that 12,533 level, that previous low, on 2 occasions. So some quite clear key levels here to keep an eye on in the DAX. Obviously a break of here will put us back in this kind of price band that we were in pretty much through most of the month before breaking higher back on the 12th, and then the bigger long-term downside target being that double kind of bottom from end of June and the 6th of July, which is more down around 12,300. So the DAX here at a key level, but could be susceptible to further downside pressure if we were to break that. And certainly if the US come in, bearing in mind that the news came out on this this defeat with the 2 Republican senators opposing the latest version of this healthcare bill. That came out roughly around 1:40 a.m. So I'd say a majority of the US participants have not been able to fully react to this news. So what will be interesting is when the US come into market, so I'm talking around 11:30 London time, 12 o'clock, when the kind of early birds start coming into their desk in North America, will we start to see a little bit of a second phase, if you like, to this move? Would be something that I would, kind of be prepared for. Looking elsewhere, then, as I said, both major pairs have moved to the upside. It's quite unbelievable to think the euro's trading up near a 116 handle. Just going on a daily continuation chart, trying to see when the last time we were up at these types of levels. You're going to have to go back to May of 2016, and you can see again, I know there's quite a lot of lines here on this chart, but if we were going to the 116 handle upside, then that peak of 2016 came in at 116.30 and a half. This is on a daily continuation. And so we're not too far from breaking that. We'd have to go all the way back to summer of 2015. We were last at these levels. And this, of course, comes with some hawkish expectations heading in towards the ECB, which we're going to get later on this week. So it's going to be very interesting on the wordplay from Draghi, how he's going to manage this, given how high the euro is at this present point. And then looking at the pound, obviously, despite some of the back and forth on the Brexit situation, the pound's remained pretty resilient at this point. And obviously we've got a real key, probably the most important economic data point out of the UK coming up later this morning in around an hour's time in the form of UK CPI. But we're not too far off the run-up that we saw towards the end of last week on the 14th. We peaked at that point late that evening at around 131.41. We're trading just shy of that, about 15 pips at the moment. So an upside level to keep an eye on. Certainly if this inflation number is on the upside, could definitely breach that level. It's within sight. Would be unsurprising. I guess if we start drawing this chart out, again, a bit longer dated, break of that level, then as you well know, in the context of where we trade at the moment in cable, would put us back up to those September 2016 highs. So let's have a look at some of the other headlines that have come out. There's a few other things to get you up to speed on, to get you prepared for this morning. And one is the RBA. So let me just pull the Aussie dollar into focus, and then you can see the move that I'm talking about, because really the chart tells you something's been going on here. So this is one of the first things, I guess, what I do when I come in is, yeah, I mean, yes, I go through my normal routine of looking at Twitter on my way in. I read some bank research reports, and I kind of scan a couple of other things that contacts send me. But the first thing when I sit at the desk is you look at the charts, and the charts will, a picture paints 1,000 words, doesn't it? And you can see here the Aussie has really seen a big move overnight. There's got to be something going on. And yes, you've had the dollar weakness, the dollar index. Yeah, it's pretty steady at the moment, but it is down 1/3 of 1%. So it weakened substantially overnight on the back of this latest Congress development. But you can see here, really powerful move in Aussie dollar to the upside. So not just dollar weakness, what you've had here is the RBA overnight said they see better economic outlook and a neutral cash rate at 3.5%. Aussie dollar surging to a 2-year high as growth seen speeding up. The RBA said despite global upswing, jobs and housing though does need monitoring. But the central bank, the RBA, said the nation's economy was improving and estimated a neutral interest rate about 2 percentage points above the current record low level. So again, you're talking about a currency or policy divergence driving further kind of gap between the two different directions of these currencies at the moment. Flagging dollar on the back of uncertainty about Trump and the administration, their ability to implement their policies against a much more surprisingly hawkish RBA with a very positive assessment of their local domestic economy. And so hence, this policy divergence or economic performance widening, you get this really big outright move in the currency. So Aussie dollar seeing a very nice move in the overnight session. So just to be aware of that stemming from those two factors. Otherwise, a quick look at something where this isn't immediately market moving, but I always think it's worth giving it some context just in case we start to see OPEC or oil related comments. And this is looking at the compliance levels. Now, we've talked a lot about, well, really it's this period here, March, April, May, where OPEC have been over compliant as a whole. Now, quite interestingly, what we've seen in the latest June numbers is that OPEC now have dipped for the first time in 4 months back to below 100% compliance. Non-OPEC nations have continued to step it up, but what you're starting to see is Saudi are continuing to do over and above. So here are the statistics. The two biggest producers, Saudi Arabia and Russia. So Saudi Arabia made 122% of their promised reductions in June. So they're over compliant by an additional 22% over what is deemed necessary for Saudi. The Russians, which were always flagging slightly, are now to 94%, so almost completely there. This is the chart which really sums it up because it helps you see who's over-delivering on the cuts. So Saudi Arabia, Venezuela, Angola pretty much to the T. But look at Iraq. Iraq is only cutting by 59,000. They're supposed to have cut in June by 210,000. If you remember some of the graphics that I'd shown you guys before, Iraq's always been the least compliant. A lot of reasoning about the ongoing kind of terror-related disruptions that they've had to their oil supply, meaning that they're kind of way down on where they would be like to be producing, particularly given the fact that those the fallout from the war and terrorism has meant that fiscally they're in an extremely weak state of affairs, and so they want to be generating as much possible from their oil revenue, and so they've been very reluctant to be cutting output. Algeria doing less, Ecuador, Gabon, and then you're looking at some of the non-OPEC names, and so really it's Saudi, as we've always come to believe now, shouldering the burden for the majority of these other smaller producing nations. But the question marks will be is how long can this be sustained for? And so this question mark over the influence and the effectiveness of these cuts from OPEC, I think, is still for me a negative. I don't think they're enough, and I do think they need to do more, and I do think that ultimately it's a losing strategy, because I still think that from a US point of view, the balance of power is definitely on the North American side. And as I say, I wasn't here yesterday, but quite interested to see that oils just continue to just ebb lower through yesterday's fairly, as what I'm told, a quiet session. We're back down to $46. So obviously you've got the API crude oil inventories coming out later this evening. The regular DOEs then will follow in tomorrow's session. But certainly I would say the data that we are seeing now on the compliance level, and as to be expected because of this artificial movement that we saw from the maintenance seasons, as I explained last week, to kind of circumvent actual cuts, is what they did in the first part of the agreement, which was originally agreed in November at the end of last year. So now these countries, these oil-producing nations, very reluctant to be cutting back. Given the price of $45, every single country is out of the money, so to speak, in terms of balancing their fiscal budget. So still to watch at this point, crude oil. I wouldn't say there's a great deal going on right here, right now, because as a session change, we're pretty much flat for the moment. I guess looking at where we trade technically, we've already had a little look this morning below the late US session low. You've got the morning low from yesterday coming in pretty much in line with the $46 handle, as some downside areas to keep an eye on. The S1 at 45.83. Okay, moving on. Another story. so you're aware, and this is kind of really the big deal for this week. You've got UK inflation numbers, which have the potential to be very important later on this morning. We'll touch on that shortly, but otherwise it's the ECB. The ECB is important. I read a note from Deutsche Bank yesterday. Deutsche Bank was saying they expect Mario Draghi to open the door to a September decision on QE without pre-commitment. So what we're really looking out for here is not an express statement saying we're going to start tapering, but a slight hint and kind of elevation in commentary to say that we will start talking about the idea of bringing in this QE taper in September, to start talking about it in more detail. But again, don't be expecting any kind of pre-commitment. That's the last thing that these central bankers ever do, much like politicians. They very rarely pre-commit on anything because, as you well know, the markets can change on a dime very quickly. A unexpected event can happen and the economy is on a new predefined course, which means that if you had already pre-committed with forward guidance, it could be very difficult to maintain credibility when you're always moving the goalposts, so to speak. So Draghi's kind of a really big deal. We're going to talk about this much more detail as we go through into the actual event later this week. But one of the main things that a lot of people are looking at is there's a bit of a divergence going on amongst various different central banks within kind of Western Europe, so to speak. They're all experiencing, though, a shared situation when it comes to inflation, which is still relatively anemic. Now, in the Euro area CPI, excuse me, we are nearing target, but we are by no means kind of, I'd say, punching above it to a point where you'd think, right, we've got to really get our game face on and start tightening policy. Very different situations to what we're seeing with the Bank of England at the moment, where obviously we've had quite rampant inflation of late, and what's uncertain is where does this inflation peak, whereas in the Eurozone we've sat below target. We've only ever really got to target very briefly a few months ago. But if you're looking at other nations like Switzerland, what they've got here, Romania, inflation still very low on those measures. Speaking of Brexit, not a great deal going on. As you well know, they're going into the kind of second phase of meetings, so to speak. I did see a absolutely hilarious picture yesterday. I couldn't help but keep half an eye on things on Twitter, and this picture absolutely cracked me up. Just got David Davis sat there with the rest of his UK counterparts ready to negotiate, quite relaxed, sitting back in his chair, all laughs and smiles, with actually not one piece of paper, not even a pen in his hand, compared to the jumbo documentation that our EU chief Brexit negotiator Barnier has got with his team here, comparative to David Davis, who looks like he's just rocked up. Come on, let's have a chat and a cup of tea. Yeah, not exactly filling the world with confidence when it comes to the British side of negotiating Brexit. I did send this article out though to you. It's worth a read. It's talking about, in summary, and obviously we've talked about this a lot, about the need for a short-term transitional deal, about how the legality surrounding such complexity of exiting the EU successfully is nigh on impossible on this 18 or 24-month period of triggering of Article 15. So what is particularly key is securing a transitional deal. Now, one thing that this FT article is suggesting is that, you know, even securing that is not exactly a done deal that then you can kind of relax and we've got many years to thrash this out. Because if you think about it, senior Whitehall officials they've quoted as saying the worry is that many companies will never have certainty that they will need to be in order for them to invest. If you think about it, if all that happens in the period from triggering Article 50 to March 2019 is we've secured a transitional deal, then all this is going to lead to, from a company perspective, which ultimately is critical for the performance of the economy going forward is they need some form of clarity at least to know then the decisions that they need to make well ahead of time about size of their staff, the investments into new projects, into building new facilities, cost cutting. All these different things need to be done with some degree of forward planning, i.e. 2 to 5 year horizon. Very difficult to do that though for companies going forward if what we're talking about here with the transitional deal is Brexit being negotiated for possibly another 5 years from now. How do you plan for that as a company? Very difficult. And I think this is some of the issues which this article talks about. I did tweet it and send it out to you guys earlier, so please do take a read if you have time. One of the other things that I did see as well yesterday was over the weekend there was quite a lot of new polls that were coming out, opinion polls in the UK, which is always quite interesting to look at, just to see what the kind of vibe is nationally post the general election. As we know, we've seen this very big sea change from the Conservatives getting that slight win at the election when the popular vote they won by 2.5%, to now we've had 10 opinion polls since the general election. Only one has the Conservatives been in the lead, and that was by a whisker of 1%. If you look at the YouGov Times poll, which was only about a week and a half ago, Labour were ahead by 8 percentage points. On average, Labour is ahead by about 3.9% at the moment. And so one thing that's quite interesting here is obviously it's almost the worst, or the more poorer the Britain negotiate or get these negotiations with the EU underway with formulating a cohesive and concrete Brexit plan, and the more infighting there is on the Conservative side, which has been quite clearly evident over the last few weeks, and still the uncertainty about how confident they are in their own leader, Theresa May, it's almost just fueling the fire for more, I guess, the nation becoming more impatient with the current working majority, the Conservatives and the DUP, and is further then providing some support for Labour. And it does bring about interesting question marks about the whole deal and its future going forward. So certainly something to keep half an eye on going forward. Okay, quick look at the data then and the schedule for the session. UK CPI, that's really the biggest data point for the morning. Now let me just bring up the CPI reading. As you kind of know the drill here now, UK CPI at 2.9%, it's the highest it's been since June of 2013. We've had this continued pattern of just trending higher really ever since October to November of last year. This is when we started to see then this sharp depreciation of the pound started to materialise in higher prices in the UK. So expectation today is, on the year-on-year reading, if we've just flipped back to the expectations here, is 2.9%. So on balance, surveyed economists are expecting this number to remain constant at 2.9%. The obvious risk here is that we get an upside number. Now, with the pound ahead of big data, you often start to see some fairly interesting pre-market positioning, let's call it that. Or in other words, what looks like someone on the inside's got some inside information and they're trading the number ahead of time. Well, just have a look at cable now. As I'm speaking, we've just broken that high print from the 16th, so that would have been Sunday night, reopening of trade to get the week underway. We've just broken to fresh highs, 131.50. Granted, the dollar is weaker this morning on the back of the healthcare bill failing again to get repealed, but definitely be keeping an eye on the pound over the next kind of 25 minutes or so ahead of the numbers coming out. Tends to be fairly telling, the pre-market movement ahead of then the data coming out. Obviously, I've just looked at cable now. This is kind of multi-month highs here, having broken that weekly high. Upside then, there's plenty of room. Now technically we've broken that. We've got R2 131.64 is the next kind of obvious target. But this inflation number will be key, because really then it's going to tell you who's right and who's wrong at the MPC at the moment. And very difficult argument, because there's no right or wrong answer between, are you more concerned about not wanting to fall behind the inflation issue, and if you're scared of that overshooting in excess of 3+%, that you want to take action now, as Forbes, Saunders and McCafferty wanted in the June MPC meeting at the Bank of England? Or are you more afraid of anemic wage growth, uncertainty and the expected slowdown in economic kind of productivity in the UK, savings rates at 50-year lows, and all these other household and consumer confidence measures which are obviously weakening amid this inflation squeeze? You know, which one do you put higher priority on? And so how high inflation goes is going to be really telling, because if inflation goes to, let's say hypothetically 3.2%, not saying that that's going to happen, but if that did occur, then it's going to force the Bank of England's hand, because if it's going to 2.9 to 3.2, the likelihood is then this is a continuation of an upward trend. Very hard to not act, because if they continue not to, and inflation continues rising, they're going to just fall behind the curve, and there's a latency to the impact that hiking rates will have in order to negate rising inflation. And so they're very mindful of that. Now, on balance, they're still viewing the overall economic slowdown and the ability to keep a more accommodative overall policy stance as the right choice at this point in time. But what's going to dictate whether or not the rest of them shift into the hawkish camp is going to be really these types of inflationary readings. So for sure, I would be keeping an eye on the pound over this release, which is coming out in about half an hour's time. Other data points for the morning that you've got to be aware of: you've got the ZEW Economic Sentiment Index. It's coming out of Germany. I would say this is probably around definitely top tier economic data out of Europe. It's very close to the likes of the German IFO. I'd say IFO probably is a little bit more important, because that's a survey, forward-looking sentiment survey or soft piece of economic data, but it comes from companies themselves. How confident are they in Germany? This is about analysts and economists. What's their forward-looking outlook? So this will be quite interesting. Looking at that, it's been relatively robust measure. The previous reading of 18.6 was a little bit below expectations. It was the first fall in 4 months amid a slight drop in expectations. But by contrast, the assessment of the current economic situation in Germany rose by 4.1 points to 88 points. So actually, if you're looking at economists and analysts in Germany in terms of a current economic situation, the previous report, they said that that measure was at its highest level since July of 2011. So currently, right here, right now, very, very bullish on their prospects. So be keeping an eye on that number. That's expected to be relatively unchanged, though. Going into the afternoon, you've got 1:30 data, but what I would say is you probably want to be monitoring the markets quite closely at around midday. That's what I'd kind of classify as the North American crossover, to see how they interpret this failure on the vote on the healthcare issue, because a lot of the majority of people in the US wouldn't have had the chance to react to that as yet. Given the timings, that would have been very late US hours, well after market close. So it might get another kind of secondary move later on. So that would be potentially dollar weakness or renewed weakness again, and further equity weakness, which would likely spell then a bid tone to fixed income futures. Finishing off, you've got the API crude oil inventory data coming out as per usual. That'll be much later on in the evening. Okay guys, just gone through 9 o'clock then, so I'm going to leave it at that. So overall, generally a bit of a risk-off start to the morning session, chiefly derived from the back of Trump suffering another defeat as Obamacare overhaul has collapsed once again. Question marks then about implementation of future policies. European equities on the back foot, as is the dollar. Both pairs then on the ascent, looking out for the UK inflationary readings to really add some volatility short term to the price of the pound. And then this afternoon, just be mindful of when the US come in, how they react to that aforementioned news. Okay, guys? Have a good session. Any questions? I'll be in the chat room throughout the day. Thank you very much.